We are live. Hello, everyone. It's Elena, real estate investor, and my guest today is awesome French lady with very cute foreigner accent, Elle C Rhodes. Elle C Rhodes is a loan consultant. She's my dear friend. She's very experienced, and it's our first podcast together. Hi, Elle. Welcome.
Hey, I'm so happy to be here. Thank you so much, Elena. And I just want to say thank you to all of you who are joining us too. We are here. If you have any questions, we just want to make this lending world a bit more easier to understand. And let's make it kind of fun because it's not always really fun. So let's try to make it light and not too strenuous.
Right, right. So our main topic today for Elle, for us, will be private money lenders, hard money. What is the difference? What are the nuances about hard money lending and private money lending? And our second part topic will be different type of loans, which we will touch base in the end. So, Elle, could you please tell a little bit to us who you are, what is your job, and how you related to private money and hard money, just to make people understand a little bit more.
Yes, of course. So my name is Elle, and I call myself a loan consultant. Why a loan consultant? Because I'm always teaching borrowers about what are their options. A lot of people who come to me, some of them are experienced borrowers, but some of them are quite new, and they don't really know which loan will be the best for their scenario. So I love to teach people and explain them the different options and what kind of thing we look like, because of course it's different if it's a hard money loan or a private money loan. So I spend a lot of my time actually teaching people, and yeah, I really enjoy it. So that's why I call myself a loan consultant. But it's like a broker, you know. And so I have a big network of private money lenders and hard money lenders. That's why I know a lot about both worlds. That being said, I want to do a little disclaimer. I've only been doing that since about 1.5 years. So I'm not like a 20 years old experienced person in the business. Okay. The real estate business is quite new to me. So I do not know everything yet. Okay. I know a lot, but I do not know everything. So just wanted
You
to,
are on your way. You are on your way.
yes, yes. But I just wanted to make that clear to everybody. I don't pretend to be an expert, you know, but I definitely know a lot that I can definitely answer most everything.
And please don't underestimate yourself, because I remember there are people who watched our first podcast. They were everyone was amazed with your professionalism and with the amount of information you
Yes,
have and you can give to people. And it's
yes,
so cool. And let's make this podcast as much as possible valuable for us, for people, for real estate
yes,
investors, right? We want to give people the most information about hard money, private money. And people, please, if you watch us right now, don't hesitate to ask questions in the chat. Introduce yourself in a couple words and ask any questions about private money or hard money, how it works, different laws. Any questions, please?
yeah.
Yeah, thank you so much. Thank you so much, El. And my first question probably is very easy. So, how you can explain the key difference between hard money and private money, and especially in the context of real estate investing?
Of course. Well, harmony is always real estate investing. Okay. So, what does harmony means? It means that it's backed by an asset. So, a real estate asset. So that's what harmony means. So when you have a harmony loan, it's always real estate related. Okay. So private money, obviously, it could be for different things, but we do real estate here, and that's what I do too. So the main difference really is that hard money is usually those are companies, you really have
Mm-hmm.
three broad type of lenders. You have the banks, right? Then you have the hard money lenders, and then you have the private money lenders. So as we know, the banks
Mm.
are institutional and they ask for a lot of paperwork and they take forever. So they are not so good for investors because investors they need to close quick in a few weeks, and banks they
Yep.
can take more than a month. They can even take a few months. So that's where comes the hard money lenders. They're
Mm-hmm.
not big institutions like the bank. They're smaller companies, and usually but they're also private. Okay, usually their funds come from even people that they know themselves from their own circles.
Mm.
They comes from family office, from hedge funds, from investors. So they have a whole network, okay? But the difference between
Oh
them,
wow.
even though it's private money, the difference between them and what we call private money lenders when we do gaps and
Yeah.
small positions like that is that they have an official company with a website. I mean, private money lenders can have a website too, but they're more like they advertise themselves. You can find them online, right? You can't find small private money lenders who do gap position online. That's much more difficult. So
Yeah.
they're more like an established company, but they're not big institution like bank, and they come to help real estate investors that can't afford to wait weeks and weeks or months to close a deal, right?
Yeah. Yeah.
And
But you know,
hmm?
go ahead. Go
So,
ahead. Sorry.
yeah, so that's pretty much, I think, what I could tell about Harmony Lender. And they have also less stringent requirement than institution like banks. They still check, even though it's called hard money lender, and a lot of people are going to tell you, oh, yeah, it's solely based on the asset. Well, it's
Yeah.
rarely so. Usually they still want to see a credit score because, and it makes sense, if someone doesn't know how to manage their finance, because they're lending private money, right? So they don't want the money to be lost. And people say, yeah, but there is an asset. Why would they care? Well, they're in the business of lending. They're not in the business of
Yeah.
acquiring property. They don't want you to default on your loan and then they need to acquire
Yeah.
the property. They don't want that. Of course, it's a backup security. That's why they do
Yeah.
it. That's why it's called hard money, because there is a backup security. But at the end of the day, that's not what they are here for. They just want to lend you the money and they want you to give back the money, right? So usually they do check credit score, but it's not so
Mm-hmm.
stringent as the bank. They don't have such big dog requirements, and they're
Yeah.
quicker. And then
Mm.
does
You're,
that
excuse me,
matter?
you're talking right now about hard money, right?
Yes,
You're talking about hard money. Okay. Yeah, but
yes.
excuse me, but you totally broke my knowledge. It seems I know nothing. I was believe banks are hard money. Really, banks are hard
No,
money.
no,
No.
no.
Okay.
Banks
Could you
are
please explain
institutions.
us? Oh my gosh. Okay. Could you
Banks
please
are the
explain us what is
institution.
the difference? What is the difference between hard money and
A
banks
bank
in this case?
Yeah, a bank is they're big institutions. So I
Yeah.
don't know much about it. Unfortunately, that's where my knowledge is a bit reduced because I've never used the banks because that's not what we do as real estate investors, right? In the real
Hmm.
estate
Yeah.
investor world, because what I just say, we don't really use, some people do, but it's more rare because they
Yeah.
are very slow. They have huge requirements and they're too slow, and real estate investor they can't afford to wait for weeks and months. So that's why we have hard money lenders, because they're faster, they have less
Yeah.
requirements, they check less,
Mm.
but something I forgot to say, they're more expensive, obviously. Hard money lenders,
Mm.
because they're quicker, they are going to be more expensive. Banks will have cheaper rates. And even now,
Yeah.
the Feds, they lower the interest rates. But you got to know that doesn't touch the hard money lenders. Hard money lenders are not regulated by the Feds.
Mm,
So
mm, yeah.
they're kind of the wild west too. You know, they're actually private lenders. They're not institutional lenders. So,
Yeah.
um, but they still have like a regular rate that they all. I'm not quite sure how they regulate it. Again, that's where my knowledge is a bit reduced. I can't tell you guys
Hmm.
how they do that, but they all have like a bridge loan. It's going to be between 10 to 13%. And it's going to
Hmm.
depend on a few things like the lender, obviously, but also the credit score, the experience that they like to look at that also, and obviously the assets, you know, the value of the
Yeah.
asset, etc.
Yeah, and
So,
you know, right now we got awesome comment from Katie Young. She says hard money loans can be group of people who loan money. Yeah, it's pretty much clear. But ladies, what is the difference in this case between hard and private money? Because private lenders they loan money as well, and they could form groups as
of
well. I
course,
met
we know those.
many times
Yeah,
managers, right, like capital raisers or managers who hired by several private lenders, and they form some union,
yeah,
and this manager
yeah,
manages money from the
exactly.
private people. So yeah, my gosh, such a deep topic, such a interesting.
Yeah. So a bit the difference is that private money lenders, the one we use in our community, right? They are more like people like you and I that lend their own money, and sometimes yeah, they can fund groups and they lend, they bring everyone's money together, everybody in the group, right? But they do you don't usually use hedge funds or family office. They lend their own money. Usually, often it's their 401k or something like that. Yeah. So that's what we call private money lender. And the big difference too between those private money lenders and hard money lender is that
Yes.
often, most of the time, not always, but most of the time, they're okay to go in second position, gap. They do
Oh.
gap. And harmony lenders, they will not go in second position. Of course, you could have some exceptions. So everything I tell you here, understand it's usually and in general, but because we just said that hard money lenders are also private money lenders, so they can kind of
Yeah.
make their own rules too, right? They can do a bit what they want. So some of them might do second, but I have never met those, or very rarely. So usually they only do first position, and then a lot or most private money lenders that we know in our community that lend their own money, that's where they come in for the gap.
Yep.
Second
Yeah. Yeah.
position.
Yeah. It's interesting. You know, I would like to observe dynamic in the nearest couple of years and to see how it will change. Because me and my community, we are under creative investment, right? It
Yes.
means we always need private money. And I
Yes.
see more and more private money lenders tend to start lending creative
Yeah.
deals to sit on second lien position, and
Yeah.
it makes me happy. It
Yeah.
makes me happy.
Yeah.
We'll see how hard money will work in a couple of years, maybe in the end of this year. It's cool,
Yeah.
cool. Yeah, and another my question to you is how do
Can
private
I,
money? Yeah,
Elena, I'm
say
so
again.
sorry. Can I just finish something to just wrap it up what
Absolutely.
we were saying? So
Yeah.
basically, guys, that's kind of the difference between bank conventional lending, hard money lending, and private money. And then the last thing is I touched a bit about it, but not with all the three of them. The interest rate, right? So the banks will have
Yes.
the cheaper, and it's tied to the Feds. Then you have the hard money lenders who are a bit more expensive. And then you have the private money lenders, which are the most expensive usually because they're the ones who take the most risk. And again, in private money lenders, you have to difference what we talked about last time. They are the ones that know and trust you, that are part of your circle. And those, they might be cheaper, but the private money lenders that do it as a more regular thing and more professionally, right? They will charge more because they take more risk, and also they spend a lot of time vetting the borrower, vetting the deal. They don't know you, they don't trust you, so
Yeah.
it has to make sense for them to make a good return. Otherwise, it's not worth it. So usually,
Yeah.
right, if we talk about this kind of private money lenders, they will be more expensive than the hard money lenders, and then
Hmm.
the bank will be cheapest. But again, the bank, it's more difficult. They have more stringent requirements, and they take forever. So most
Yeah.
they're not
Yeah.
worth it for
Bank
investors.
banks are too huge and too bureaucratic, right?
Yes.
We usually don't use bank. Don't tell
No.
to banks, please. We don't use
No.
them.
Those are for like private people, like families, for their own residents, right? For primary residents, not for investors.
Yeah, yeah, yeah,
Because
yeah. Actually, you.
also, hard money lenders, they don't work with private residents. Okay, you cannot go to a
Mhm.
hard money lender if you want to buy your own house and you're like, I don't want to go through the bank, I want to go quick. Well, they only work with investors.
Yeah, yeah. And you see, I see more and more private lenders who comes up to market. They united. They form the unions, and it's so pity. Usually, people don't know about this opportunity. They usually standardly go to bank to request loan, right, to buy the house. Really,
Yeah,
whoever can use private money or not institutional hard money, I mean private hard money, something weird to me, but anyway, no bank, we can use it, whoever can use it to buy house. And okay, and you probably almost answered my next question. So my next question was, uh, I would wanted to ask you to compare hard and private money in terms of interest rates, but you answered already, and loan terms and approval process. Little bit more.
yeah. So the loan terms, that's something we didn't talk about yet. So
Yep.
another reason why people will choose hard money lenders over private money lenders is because not only they're cheaper, but they usually, and but also they have longer terms. Usually, private money lenders, they don't like to lend more than 6 months. So if you need a longer term loan, or like a DSCR, for example, which could be 30 years, you can't get that from a private money lender, obviously, right? Who would want
Yeah.
to tie up their money for 30 years? That doesn't make sense. So in that case, you go to a hard money lender. So in terms of terms, length of the loan, private money lender would be shorter and hard money would be longer.
Hmm. Oh, cool. Yeah, but I would not say too strict about terms for private money, because sometimes creative buyers, we have a really personal relationship with private lenders, and
Yeah, then it's
people really.
different.
Yeah, yeah, yeah. It's different. I agree. I agree. It's not institutional usually, right? And they like to see with the same investor for longer than 1 year, even
Yeah,
2 years, because
yeah.
they form passive income, and a lender knows the investor, and lender trusts the investor. So why would they should
Yeah,
jump from one deal to another, from one
yeah,
project to another? Yeah, it's
yeah. But that's when you have
okay.
personal relationship with them, which is different, right? So what
Yeah,
I'm talking about is not personal relationship, but when you don't know
yeah,
them.
yeah, yeah, yeah. And it's interesting. The dynamic is very interesting right now. And could you please, El, walk us through the process of securing a private money loan for real estate deal?
Okay, so everybody, again, because it's private money, everybody has a bit a different way of
Hmm.
doing it, right? Because there's as many ways to do it as there are private money lenders out there. But
Yeah,
being part of the community, and working with some of the most amazing people in the community, I know that we have some standards that we like to follow to make sure that the
yeah,
lender is safe. Because the last thing we want to do is borrow bring a borrower to a lender and then the borrower
Yeah.
defaults and we make the lender lose money. This is terrible. So basically, one of the things we have is like loan to, it's called LTV, and some lenders have a different approach to it. So LTV means loan to value. So loan is
Yep.
all loan combined. Let's say, because we're talking about PML, right? So let's say we have a second position on a property. Let's make it simple. Let's say the property is 100K and we have an
Mhm.
80K first position loan and they're asking for a 20K from the private money lender, right? To make
Yeah.
100.
Yeah.
So what we are going to do is usually lenders, PML, private money lenders, and even like all kind of lenders that are professional and know what they are doing, they're going to have a loan to value, which means they're not going to go over that because otherwise it's too risky. And if the borrower defaults, they for sure going to lose their money. So they all have a bit of a different criteria for that, but the highest I know of is 75% of the ARV, meaning that
Hmm.
all the loan combines cannot be over 75% of the ARV. But
Yeah.
some lenders I work with, some private money lenders, they even go lower than that. They will be at 60 or 75% of the loan
Hmm.
to cost, so the price, the purchase price, or the loan to value. So it really
Yeah.
depends on the lender, right? But that's definitely, you don't want to go to 100% of the value or of the ARV because this is really crazy. If the borrower defaults, for
Right.
sure you're losing a lot. You
Right.
might lose everything or a lot of your money, right? So this is one criteria. Then they like to see experience usually because again, they're lending their own monies and they don't want the borrower to default. And if someone doesn't know what they're doing, then they might just tank the project. Even someone who knows what
Mhm.
they're doing might tank it, but even more so if it's a beginner. So but beginners should, it's not fair because they should still be able to start, right? So how do we fix that when I have a beginner who comes to me and say, well, I don't have experience? And I tell them,
Yep.
well, do you have someone who can jump on the LLC with you that has experience? Because anyway, when you're a beginner, you shouldn't just do it on your own. You should like, I mean, I shouldn't say you should, but it's always smarter if you talk to all the bigger real estate investors out there, they will always tell you don't start on your own. Like join a team and do it with people because you're
Yeah.
gonna make less money, but for sure gonna make some money. You're probably not gonna crash, and then you're learning in the process. Because when you start in real estate, anyway, whether you're doing loans or investing, it's not about making money; it's about learning. And so,
Right.
what's the way to learn than to have experienced people on your team that are going to show you the ropes? So they look
Oh
for
yes.
experience, yeah, and that kind of things. I think that was your question, right? I can't remember the question
Yeah.
exactly.
Just I asked you to walk us through the process of securing a private money loan. What else maybe they are looking for? What is important for them?
Well, okay,
So,
so that was for the deal, vetting the borrower. So also if making sure that the borrower, since we want people with experience, right? We're
yeah.
gonna
Yeah.
talk to the lenders, to the previous lenders, to see if this was a good borrower, if their communication was good,
Mm.
they paid
Mm.
back. So we check these kind of things. You're making big eyes.
Oh wow! So it no, it's for me. To me, it sounds like when I had W-2 and I found new job, right? And my new employer, they've done something like background check. They called to my previous employer with these
Yeah,
questions.
yeah.
Everything's so serious. It's money.
Yeah,
They
I
want to
mean, people are
secure.
lending. Wouldn't you want to check on someone if you're gonna lend? Like sometimes they lend big amounts, like 500K, or. So of course they want to make sure that the person is legit and
Yeah.
that is a good person to work with, right?
Yeah, absolutely. Of course. Yeah, of course. When I will start land, oh my gosh, how picky I will be.
You see, yeah. People don't realize when sometimes when you're on the borrower side, you're like, oh my God, this is so annoying. But put yourself in the lender's shoes. What if it was your hard 401k money that you're lending? You're not going to just hand it out like that, you know? You're going to be picky because so
Yeah.
many people are looking for gap funding. So you're going to take the best for sure. Yeah.
Yeah, absolutely. Yeah. Okay. Let's jump to loan types a little bit. Okay. So
Yeah.
honestly, to me, it's still like deep woods. DSCR, transactional lending, whatever, all this type of loans. It's just really deep woods for me. Could you please describe us the most useful, most common loans
Of
in real
course.
estate
So,
world?
okay. So let's start with the hard money loans, which are the basic ones. So you got usually you have mainly you have three, I would say. You have fix and flip, so which
Mm-hmm.
mean you purchase or just acquisition plus fix, you know, or just acquisition. And so usually those are called bridge loan. They're really short. They're usually 6 months to 1 year, and that's the time that the investor needs to fix the property, you know, and they're
Mm-hmm.
usually more expensive. And then either they sell it or they go
Yeah.
into refinance and put tenants in there, right? And they refine. Why would they refinance it? Because they're going to get better terms. It's going to be a
Yeah.
cheaper rate, and those are called DSCR loans. And
Oh, now I know.
yeah, so that's, and they're usually 30 years. And right now, the rates, again, it depends on the borrower's credit score. And DSCR means debt. Oh my God, I'm going to forget DS, debt, no, no, ratio, debt service covering ratio, which
Here is
means,
it.
yeah, sometimes I forget those words because I always say DSCR. We never say the whole word, obviously. But
Yeah.
what it means is like how much money do you make? So those are determined not really on the asset, but on the cash flow of the property. That's why they call debt service coverage ratio. So how
Mm-hmm.
much do you spend the PITI? What's the PITI, right? And then how much do you make? So you should make more than the PITI because otherwise,
Mm-hmm.
if you make more, it should be plus one. Your ratio should be plus one, more than one. I mean, one and plus. That means that you make
Mm-hmm.
more than what you spend. Then if you make less than your PITI, then it's a no ratio. It's called no ratio DSCR. Not everybody does it, but some hard money lenders, they do no ratio DSCR. But anyway, that's how
Mm.
those are calculated. And depending on the ratio, the rate will vary.
Oh.
And on those, so the lender knows they're going to be paid back because your
Yeah.
ratio is above one, which means that you make more money. So then for sure you're going to be able to pay the interest. So that's how those are calculated. And the best picture, the better interest rate. And right now the interest rate, if I remember, they're around between 7 and 9% on the DSCR loan. Again, depend on the ratio, on the credit score. Yeah, that's mostly the things that they look at. So,
Mm.
so let's.
Mm-hmm.
Does that make sense?
Yeah, it makes sense. It absolutely makes sense. Yeah, so interesting. Yeah,
Yeah,
and
I
you
love it.
said
I really love it.
people usually use DSCR when they do fix and flips, right? Because they
No,
want.
after. So you can only get the DSCR once the rehab is completed. You cannot. That's why you need to start with a bridge loan. So the bridge loan, you're gonna make the rehab, and then you go into the DSCR once the rehab is finished, and then you get the
Oh.
tenants, and that's how you calculate it. Yeah. Some people though
Oh.
can get direct into a DSCR if they don't need rehab. So let's say you're purchasing a turnkey property, then you can
Mm-hmm.
definitely, it's better to get a DSCR right away because it's cheaper, right? But if you need rehab, you're going to need what it's, and it's called a bridge loan because it's a loan between the purchase and the long-term financing, right? So it's a bridge and
Oh.
it's a short-term loan.
Oh. Oh, cool. Okay.
Yeah.
So many different loans.
And
So
then
what
you
else?
have,
Yeah.
yeah, so still, so those are two main loans that you get with hard money lenders. And then also with hard money lenders, another common loan is a ground up. So someone is buying a land and they want to build something. It's called ground up and they get a loan for that. It's also a short-term loan because usually ground up depends on the project, obviously, because if it's a huge multifamily, it might take longer.
Yeah.
But if it's a regular single family, it's usually less than 1 year. So those are quite short term too. Of course, it depends on the project.
Mm-hmm.
And they're called ground up. And then once the project is completed, either they're going to sell it. Usually that's the case, you know. Usually people
Mm-hmm.
build usually they build it and then they sell it. But if they want to keep it and rent it, then they get into a DSCR.
Mm-hmm. Mm. Okay. What about constructions loan?
That's it. That's it. Ground up. It's called
Yeah.
ground.
The constructions loan.
Yeah,
Aha.
ground up,
With
like from the ground to up. Yeah, that's
yeah.
construction loan. Ground up.
Awesome. Awesome.
Yeah. So
What about loans related to investor who buys and holds? What kind of loans do they prefer?
this is the same. Again, it depends if you're going to rehab or not. So if you have a rehab, you're gonna get a bridge loan with the rehab, and then
Mm-hmm.
once you're done rehabbing, you get your DSCR. If it's a turnkey, you get a DSCR right away.
Yeah, I
Does
see.
that make
I
sense?
see. Yeah, yeah, interesting. So many interesting things. And Ellie, what do you see, for example, in this year? What kind of trends, maybe something new you see, or some tendencies in hard lending or private lending? Something new.
I mean, really, well, first of all, I haven't really been on the scene that long that I can really
Mm-hmm.
judge from the previous year because I was not part of this. I was not doing this, so I don't know. But I know something really big and really new in the lending scene is the Gator community. Like, definitely, the Gator community is taking the market by storm, and
Yeah,
this is really cool, you know, because this didn't really existed before and it didn't have an official name. So, and there are more and more gators from what I understand. So, yeah, it can be good. Sometimes it's not as good. It depends the people. It's like in everywhere, you know. Some people are great and some are not so great. But it's like with anything. But it's a bit wild because there is no really rules for the gators. So it's a wild community, very interesting,
yeah,
and this is taking the market by storm. Definitely, this is like people talk about it that have nothing with. I hear people talk about it sometimes that like. For example, I would talk to a title company, right? Like a regular title company, and then they'd be like, "Oh yeah, the Gators," and I'm like, "Oh my God, people know the Gators. That's crazy, right? People who are not part of the community." So yeah, it's. I would say that's a trend that is taking the market by storm, definitely.
yeah, yeah. I
And
maybe I'm wrong, but I believe this is a creation from the Pace Gator.
yes,
Maybe I'm
yes.
wrong. Yeah.
No, no, you are right. Pace created that. And by the way, we didn't talk about that. That's another type of PML lender, and they do mostly they do EMD and transactional funding. So that's the Gator. Yeah.
Yeah. Could you please explain to people who never heard about EMD and transactional funding what is this and what is the difference?
Yeah. So EMD is um, when someone buy a property, when they sign a contract, right? They say, okay, I want to buy this property. I signed the contract with the seller. The EMD is like the engagement ring. It's like
Yeah.
saying to the seller, hey, I'm really serious. Okay, I really want to buy your property. So I'm going to give you it's called a EMD, earnest money deposit.
Mhm.
So usually it's one
Mm.
of percent of the purchase price, but it varies. It depends on the seller and also on the real estate agents. Real estate
Mhm.
agents are really attached to it because they don't want to waste their time. So they want the investor to be serious. So
Mhm.
it's called. So they ask for a earnest money deposit. So it could be between 500 dollars, sorry, to like, depend if it's a huge, a huge multifamily, it could be like hundreds of thousand Ks or millions. So
Yeah, it
it
depends. It depends.
yeah, it's usually one.
Usually, yeah, just couple thousand usually, right, for average real
It's
estate deal.
usually around 1% of the purchase price. But like I
Mm-hmm.
say, it varies on the seller and on the broker. Sometimes they want
Mm-hmm.
more or less. And so it's supposed to come 1 or 2 days after they sign the contract. And sometimes people don't have that money, or maybe they have it, but they don't want to tie it up. So they want to ask they want to use EMD. They want to use a gator to lend them
Mm-hmm.
EMD. But there is a lot of requirements for that. It's usually meant for wholesalers because it's mostly meant for wholesalers because do you really want to go into the details? It's quite complicated. Do you want me to explain the how EMD works?
I would prefer you explained not too deep, but enough
Yeah.
understandable for people to get the basic.
Okay. So
Please.
basically, yeah, so it's meant for wholesaler because when you give the EMD, when you want to purchase a property and you sign the
Mm-hmm.
contract, there is an inspection period, right? And
Right.
during the inspection period, you can say, okay, once you inspect the property, you might say, okay, there is too much work here. I don't want it. And then your EMD is usually refundable. Don't take my word for it, guys. It's much more complicated than that. Don't just do that,
Yeah.
okay? There is a lot of things coming in. So I'm just saying it quickly, but it's not always the case, okay? So don't take my word for it. Just know that it's usually how it happens, but don't do it on your own. You need someone who knows what they're doing for EMD. Otherwise, you
Yeah.
could lose it. So
Yeah.
that's why usually it's meant for wholesalers, because in that case, the wholesaler, if you lend them the EMD, they're supposed to find the end buyer before the end of the inspection period. And then the end buyer
Mm-hmm.
comes in, put the EMD, and then that's how you get your EMD back plus the fees, right? So
Mm-hmm.
when it's for a end buyer, I do sometimes, right now we are working on a few. One is 500K, one other is 660K EMD. Those are end buyers.
Uh-oh.
Yeah, I know it's really good. I love those. Those are like
Yeah, I can
good money
understand.
in your pocket. We make good money on those. So I hope we're going to close them. You never know for sure. Anything could happen, but that's the two we are working on right now. And both of them, they're end buyers. They're not wholesalers, but the way we're doing it is like in that case, we're extending the
Mm-hmm.
inspection period all the way to the closing date so that the
Mm-hmm.
EMD, it's called, the EMD goes hard when it's past the inspection period, means it goes in the
Mm-hmm.
seller pocket and you cannot get it back. So that's why
Mm.
we are extending the inspection period. We're trying to the borrowers are in discussion with the sellers to see if they can extend it to the to the closing date. But sometimes the seller
Mm-hmm.
don't want it because that's the whole point of the EMD is that if you don't if you don't tell me you don't want it during the inspection period, but you don't go through with purchasing the property, then at least the seller has the
Yeah.
EMD because they've been wasting their time with you instead of looking for other buyers, right? So
Mm-hmm.
anyway, that's the EMD in a nutshell. But guys, remember, don't go on your own and say, "Oh, I know everything about EMD." It's much more complicated than that. So ask
Right.
someone who knows what they're doing if you want to do something like that. Okay? There is a lot missing in the story that I just told, and um, and then we have transaction. We have double
Yes.
closing,
Right.
right?
Oh, yeah. Yeah. Yes. Please,
Love
double
those.
closing.
Double closing are so nice, but actually, disclaimer, I've never done a double closing so far. I want to do one. I can't wait, but I've never done one. They're not so usual, and that's not really what people come to me for. But I know a bit about them still, so I can tell you what it is. Double closing is when it's
Mm-hmm.
also for wholesalers because wholesaling is becoming illegal in a lot of states. So what people do, they double close, which means there is two contracts. There is A and B, the contract between the seller and the wholesaler, and there is B and C, the contract between the wholesaler and the end buyer. So
Oh, wow.
yeah, so in order to prevent, to go around the fact that wholesaling is becoming illegal, wholesaler have to become the buyer. And it happens in the same day. So in the same day, the wholesaler buys the property to the seller, and then they turn around and they sell it to the end buyer. So it's tack tack tack. So those are great
Yeah.
to lend on because you get the money back on the same day. So it's excellent, and the money never leave escrow, so it's very
Yeah.
safe.
Yeah. Totally safe. Yeah. People make good money.
Doing those, yeah. So those are
Yeah.
called cater lending, but you have to know they're not. It looks so easy and that we make a lot of money, but again, it's not like that because not it's not always easy to find EMD or Gator unless you're a big name in the community. Everybody knows you and everybody comes to you,
Mm-hmm.
and you have to know also that most EMDs don't come through.
Yeah.
So at the end, the deal falls apart, and it could be the same with double closing. So when they come through, they're really good, but a lot of them fall through. So it's a lot of time with. In loans, it's like that. A lot of loans come through, so you spend a lot of time for nothing on some loans. But when you get paid, usually it's a really good pay. So that's what makes it worth it.
Yeah, this is a specific anyway. We cannot just constantly make money. Not you, not us investors, not your guys who lend our deals, right?
Yeah.
It takes time. Oh
I
my
mean,
gosh, you know how many deals we should underwrite investors, I mean creative buyers, to find this
exactly.
one
Same.
golden seed, right? To find good
Yeah,
cash on cash return, to find good cash flow. My gosh.
it's the
But
same, right?
yeah, in the end of the days, everyone makes something, everyone makes
Yeah,
and everyone happy.
yeah.
It's awesome, and it's awesome to have this knowledge like you just shared with us. Thank you so much, El. And I really hope, and my really the number one goal to bring value to people to understand, to explain how it works, how lending system works, to make a real estate investor more knowledgeable about all this system, to avoid more mistakes. Because, for example, for us, for creative buyers, number one goal is to make sure our private lenders' capital is safe. So we need to educate ourselves. We need to know a lot. We need to understand different type of loans, to understand how to work with lenders. And thank you, El, for give this value to
Oh,
people. And thank you. It's all every time I meet you, I learn just like a student, just like a
can I
one
just
small
say, I'm
student.
sorry, can I just say something to finish what I was saying before? I just wanted to say that even though I say, sometimes it's difficult, don't think we always make money. Some people make really good money and do a lot of
Yeah,
regular loans because they have a lot of regular borrowers. So yeah, I just wanted to correct that some of us are. I'm not at this point yet. I hope soon, but I know some of us they're making really good regular money with regular borrowers. So But those are more they are, you have to achieve that level. The rest of us, we're kind of more doing a lot, and once in a blue moon we get a big check, you know.
Consistency, my friend.
Yes,
You will be there for sure
of
with
course.
your attitude, with your positive attitude towards people and your knowledge, and with everything you share. You know, my mentor Jesse Stanton, he says us, the amount of money you make and the
Yeah,
level of your success absolutely dependent on information that you share with people and amount of people who you help.
yeah.
And in
The
our
value
business
you bring.
information, this is the best. Yeah, and information is the best help
Yeah,
in our business, right?
yeah.
So
The
cool,
value.
very cool. Yeah,
Like
thank you
you,
so
you
much,
bring so
Elle.
much value, Elena.
I hope so. I hope so, really. I
You don't
hope
have
it
to
will
hope,
help
it's
people to
true. You
understand.
bring so much value. You're amazing.
Thank you so much, Elle. You too. And guys who watch us right now, it was podcast with one consultant, Elle Rhodes, a beautiful French lady who knows a lot about lending, about hard money lending, private money lending, and me, your host, Elena Bartash, real estate investor, creative buyer, and private lenders. If you are here, guys, please reach out to me if you're looking for your next project. I would love to discuss how I can help you to achieve your goals. Thank you so much, Elle. Thank you so very much. See you next time. Let's
Bye,
bring another
everybody.
crazy value. Bye, everyone. Bye bye.
Bye bye.